Imagine waking up to a world where stock markets are buzzing with optimism, but beneath the surface, economic signals are whispering secrets about future interest rates, secrets that could redefine your investment strategy. That's the thrilling reality of today's market updates, and if you're not tuned in, you might miss out on the game-changing shifts. Let's dive into the latest on the Dow and S&P 500, straight from the global trading floor. As of November 25, 2025, at 10:36 p.m. Universal Time Coordinated, with an update rolling in on November 26, 2025, at 1:35 a.m. Universal Time Coordinated, Asian stock markets continued their upward momentum for a third consecutive day, riding the wave of positive trends from Wall Street. This surge was fueled by softer-than-expected U.S. consumer data, which has investors betting more confidently on the Federal Reserve announcing an interest rate reduction as soon as next month. For beginners in the investing world, think of the Federal Reserve as the central bank steering the economy's temperature when they lower interest rates. It's like turning down the heat on borrowing costs, making it cheaper for companies to grow and potentially boosting stock prices in the long run. But here's where it gets controversial. Is this optimism justified, or are we setting ourselves up for a letdown if inflation rears its head again? The MSCI Asia-Pacific Index, a key benchmark tracking regional markets, climbed by 1.2%, showcasing broad-based strength. Out of the 11 industry sectors within this index, nearly all saw progress, with the ratio of advancing stocks to declining ones hitting an impressive 3-to-1. This follows on the heels of 3 straight days of gains on U.S. benchmarks, painting a picture of synchronized global enthusiasm. For example, imagine sectors like technology or healthcare leading the charge. Each rising stock could represent innovative companies capitalizing on AI advancements or breakthrough medical research, illustrating how interconnected our world economy truly is. Meanwhile, Chinese equities kicked off the trading session on a stable note, but Alibaba Group Holding Limited's shares took a dip of up to 2.8% during Hong Kong trading, reacting to their recent earnings report. To put this in perspective for newcomers, earnings are like a company's report card. Alibaba's showed revenue beating expectations, driven by growth in artificial intelligence and cloud computing, yet the stock still fell, perhaps due to overhyped expectations or external pressures like regulatory scrutiny in China. And this is the part most people miss. In a market as volatile as this, one company's stumble can ripple through the entire region, reminding us that no victory is without its caveats. So, what do you think? Is the Fed's potential rate cut a smart move to spur growth, or could it ignite inflation worries that derail the rally? Do you believe Alibaba's earnings dip signals deeper issues in China's tech giants, or is it just a temporary blip? Share your thoughts in the comments. Do you agree with the market's bullish outlook, or do you see storm clouds on the horizon? Let's discuss and debate.